Washington, and Texas. Here's how they work. Ohio's commercial activity tax is a 0.26% tax on sales over $1 million. Most companies, big and small, pay it, and it brings in $145 per resident per year. The pros? It's simple. There's one rate for just about everyone, and it's easy for companies to pay and for the state to administer. It's also hard to avoid. Like Measure 97, this tax doesn't offer many loopholes. Finally, it has what's called a broad base and low rate, meaning with more businesses paying, the burden is spread out. The cons? Like Measure 97, this tax can be unfair to low-margin businesses like grocers. It's also subject to what's called a pyramid effect, where items are taxed several times during the production process. For example, a t-shirt would be taxed once when the raw material is sold to a manufacturer, and again when the t-shirt is sold to a retailer. Finally, if costs are passed down to consumers, it acts like a sales tax, which is harder on people with low incomes. Up next is Texas's franchise tax. It's a hybrid between a corporate income tax, like Oregon's current system, and a gross receipts tax, like Measure 97. Most companies are taxed between 1/3% and 0.75% on their total sales, minus one of 4 possible deductions. Most companies pay it, and it brings in $139 per resident per year. Pros? Again, the broad base, somewhat low rate thing, where the burden is spread out because more businesses are paying. It's also a little more fair because the deductions give discounts to small businesses and retailers with slim profit margins. Finally, it's easy for the state. There are only a few different rates, so it's easy to administer. Cons? Each year, companies must make 4 separate calculations to figure out which deduction they should take. It's also subject to the pyramid effect, where items are taxed several times during the production process. Finally, it too acts like a sales tax, which is harder on people with low incomes. Finally, lawmakers are looking at Washington's business and occupation tax. It's a gross receipts tax like Measure 97. Most businesses are taxed at a range of rates under 0.5%, except for professional services like law or dental offices, which are taxed at 1.5%. Most businesses pay it, and it brings in $498 per resident per year. Pros? Again, with the broad base low rate, the burden is spread out, and it's a little more fair. The state offers dozens of different rates for different types of companies, so low-margin businesses generally pay less. Cons? It's hard to administer. The dozens of categories mean the state has to make sure the companies are filing under the right category and they're getting the proper rate. It's also subject to the pyramid effect, where items are taxed several times during production. And again, it acts like a sales tax, which, if passed on to consumers, can be harder on people with low incomes. Oregon lawmakers haven't decided yet which route to take, but leaders are hoping to reform corporate taxation by the end of the legislative session.